Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over just a thread, and there's a whole bunch of different compelling investment wisdom. That's basically a whole compilation of this. So I'm going to go through it with everybody on the channel so you guys can understand what's going on. I'll give you my financial opinion as we read these. So let's start. This is Druckenmiller, position sizing over frequency of correctness. And I see this a lot, position sizing over frequency of how correct you are. It says it's not how often you are right or wrong. It's how much you make when you are right and how much you lose when you are wrong. That is huge. That is how I'm making my money. I am making my money by taking large asymmetric bets, position sizing it correctly, and it's okay if I have some of them not work out. Because my gains will be so large that they'll make up for any sort of other losses that I have in other sectors. So when I talk about a lot of these companies, you have to take my approach in a holistic way. It's not trying to take one or two companies, guess that they're right, and overload in them. That is where people get it wrong. Peter Lynch, time in the market versus timing the market. Far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. Again, far more money's been lost by investors trying to anticipate corrections. What I'm doing with the channel and the website is I'm identifying where the value is. I'm getting in those sectors by position sizing, by allocating capital to large asymmetric bets. I sit in the stock, I do nothing, and I wait for that symmetry, the asymmetry in that bet to realize. And I don't need every single sector to win in order for me to win big. I only need a couple. Maybe even only one sector to win big, and my portfolio wins big. Buffett said, come on down here. Big opportunities in life have to be seized. When we get the chance to do something that's right and big, we've got to do it. To do it in a small scale is almost as big a mistake as not doing it at all. And Josh replies with got energy stocks. There is a commodity problem. There's an energy crisis ahead of us. That is the opportunity. That is where we should be. That's what the problem needs to be solved in the markets. Energy touches absolutely everything. It will blow up stocks that have energy as an input. And guess what? All those companies have energy as an input. They transport stuff around the world using energy. We grow our food using energy. Energy is the most important sector in the world. It allows us to do work. It allows us to be advanced in our societies. All of the fluff when energy goes into a crisis will be destroyed. People will spend money on what they need and what they need only if that's all they can afford. The problem, I think, is in energy, and I think he has this right. Clearman, it says, value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. Few are willing and able to devote sufficient time and effort to become value investors. Only a fraction of those have a proper mindset to succeed. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And obviously, the four most dangerous words in investing is this time it's different. Sir John Templeton. And this is Jim Rogers. One of the best rules anybody can learn about investing is to do nothing. Absolutely nothing, unless there's something to do. I just wait until there's money lying in the corner, and all I have to do is go over there and pick it up. I wait for a situation that is like the proverbial shooting fish in a barrel. I've said that many times over the channel before of what am I going to do? I'm going to do absolutely nothing. I'm just waiting and waiting and waiting. And that's how you make a lot of money. Identify the big trends, identify where the value is, buy the value, and wait for that value to change over time. What I'm really looking for is a consensus the market is not confirming. I like to know that there are a lot of people who are going to be wrong. Yes, and that's probably going to happen in real estate. There's going to be a lot of people that are going to be wrong. The demographics, the inventory, everything supports a continued move higher in real estate. But most people, at least on YouTube, have it wrong with a crash that's going to happen immediately. I'm just debating on when the crash will necessarily happen. It's not immediately, in my opinion. Easy winner for me. It says bull markets are born. Yeah, that's that one. Big opportunities in life have to be seized. Yep. Said that one. Coming on down. Only when the tide goes out do you discover who's been swimming naked. Inflation, the economy, and the Fed. Being in bad places with good people has made me way more money than being in good places with bad people. If you are an investment business and have an IQ of 150, sell 30 points to someone else. Buff it on leverage. If you're smart, you don't need it. If you're dumb, you got no business using it. Basically, you don't need it. You don't need leverage. Be fearful when others are greedy and be greedy when others are fearful. Trusting the government with money creation is like trusting a drunk with a whiskey factory. Price is what you pay. Value is what you get. The market can stay irrational longer than you can stay solvent. That one's got swearing, and I'm not going to talk about that one. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Yeah, I guess I have that. I just don't, I don't care. I don't really care what other people think. Something about own companies that sell what people need, not what people want. Own companies that sell what people need. If you've been playing poker for half an hour and you still don't know who the pansy is, you're the pansy. He says Patsy, but happiness comes from spiritual wealth, not material wealth. Happiness comes from giving, not getting. If we try hard to bring happiness to others, we cannot stop it from coming to us also. To get joy, we must give it, and to keep joy, we must scatter it. You can't pour from an empty cup. Get long and get loud. Mark Cuban, I guess. Prepare and the opportunities will come. Coming on down. Successful investing is anticipating the anticipation of others. That's pretty funny. Successful trading is like getting pregnant. Everyone congratulates you on it, but no one asks how many times you got screwed first. Investors should purchase stocks like they purchase groceries, not like they purchase perfume. You don't make money when you sell, you make money when you buy. Most people invest and then sit around worrying what the next blow up will be. I do the opposite. I wait for the blow up, then invest. Actually, that's pretty smart. We use ratios. We use ratios to figure that out. We don't need to wait for a blow up. We just need to figure out where the value is. A gold mine is a hole with a liar on top. Everybody's got a different circle of competence. The important thing is not how big the circle is. The important thing is staying inside the circle of your own competence. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that. And that's what I talk about when I say I hedge myself with time. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. That is what hedges yourself. You can get an entry point that's really, really good, and then you have to wait. Or even if your entry point is poor, you just have to wait as well. So waiting is a key portion to investing, is just sitting there and doing nothing. Buy the dip. You don't make your profit when selling a security, but when buying it. Well bought is crucial to well sold. Therefore, market timing is vitally important to profit. Don't tell me what to buy, tell me when to buy it. Timing is essential for superior stock market performance. And this person thinks you can time the market. I think you can to some degree, as long as you know where the value is. The way that I do this myself is I don't necessarily try to time a specific stock or a specific thing. What I do is I just say, what's cheap in the market and what are the trends? If the trend is intact and something's cheap in the market, that's when I buy it and that's when I hold on to it. So my timing isn't necessarily important. It's buying something that's down and identifying what is down and what's valuable. That is what's important. Your timing, something will always be down, something will always be expensive, something will always be cheap, or maybe they're relative to each other, somewhat well balanced. I mean, you could have that, but if you can identify what's down, that's really your purchasing of your timing is what's down and what's cheap. So identifying value is where, and hence the name of the channel, Finding Value, is where all the value is. A rising tide lifts all boats. When the tide, yeah, I already read that one. The way to build superior long-term returns is through preservation of capital and home runs. When you have tremendous conviction on a trade, you have to go for the jugular. It takes courage to be a pig. Stanley Druckenmiller. So basically, he's describing what I thought was a perfect setup in oil and uranium still. That is where you go. You line it up, you find where the value is, you find out, hey, look, we could have an energy crisis coming up. And if the ratios are way out of whack in an anomalous fashion, that's where you go for it. That's what I did. I went heavy into oil and gas and uranium because I thought there was going to be an energy crisis during a liquidity type move. Coming down, the most important quality for an investor is patience. Most of the time, it's best to do nothing. Even better are nonsensical claims about his size effects in options market. Stick to selling subs. Cultivate a sense of your own feeling of FOMO. Know what it does to you, how and when it arises, and what its signs are. When you're entering a position and it seems to be evoking what you know in yourself to be FOMO, then it needs to be reconsidered. Self-knowledge is the key to investing success. Also knowing when something makes sense, but you're not buying or selling it because of some prior price anchor you have in your mind. Mr. Market is kind of a drunken psycho. Some days he gets very enthused. Some days he gets very depressed. And when he gets really enthused, you sell to him. And if he gets really depressed, you buy from him. Warren Buffett. So I just wanted to go over a couple of quotes that were on Twitter. I thought they were all pretty good. And they align pretty well with what I already do. And what I did is I just basically find value in the market, find it where everyone, at that time, most people are very negative on the thing that is down. They don't want to buy it. They're very depressed on it, which makes sense here, even reading Warren Buffett's quote there. And then you just buy it all up because it logically makes sense. What I did is I basically cut the emotions out of everything. And then I said, how can I objectively identify value? That's what the ratios are. Then I said, okay, what's going to cause these ratios to rotate? That's what the market conditions are. And what most people think is that the markets just go straight up or straight down. That doesn't work like that. Markets take a long time, and the market conditions can remain ripe for 10 years. So you can have cyclical pullbacks and recessions in the middle of these things so long that the market conditions are ripe. So the way that I view it now, the markets are there's an energy crisis. There's a problem. We have liquidity coming from the real estate market and from all the money printing stimulus garbage that they did. That's working its way through, and it's going to be inflationary. We have problems in commodities a couple of years ahead in a whole bunch of different commodities. This will be inflationary showing up in the consumer price index. We can have disinflation from the actual money supply coming in, but the money still has to rotate over to commodities and energy because there's problems in that. The denominator and the numerator. The numerator is the supply demand of the commodity. The denominator is what it's priced in, which is the dollars. They're both positive at this time. That's when you get that really big move. At some point, the liquidity will draw back a little bit. It'll be whatever is sustaining in the housing market. The housing market, I still think, has probably years to come. It's not just going to turn around. We are at very high rates of increase. And what we're going to look for is a slowing of that rate of increase. It's not a crash. It's a slowing of the rate of increase. And a lot of people, they look at things pretty, I don't know, pretty simple, I should say. I look at it very simple, but the way that they try to understand things. So If a house goes up for sale and they lower the price of the house, that doesn't mean the price of the house went down on a year-over-year basis. And why do we look at things year-over-year? We look at things year-over-year to remove out the month-to-month fluctuations. These things are cyclical. We have to take that cyclicality out of the data. Now I hear people, well, you better go month to month. That doesn't work, guys. It's cyclical. You can't do that. Go back. You're going to have to study history again. And I see a lot of people thinking, the market's going to crash. Well, do you say that every single year that the housing market rolls over for its cyclicality? You say that's going to crash every single time? It just makes you look retarded. I mean, that's really what it does. It makes you look like you're uneducated. Because I get a lot of people who are always, oh, it's going to crash. It's going to do this. It's down 20%. Guys, you got to cut that out. Things don't move that fast. Year over year, we need two down years. 2 down years to say, okay, we've got a problem. Flat years or down years. We have no inventory. It doesn't exist. So that whole housing market thing, everyone's pinned on the crash side. They're going to be wrong. They're going to be wrong. Maybe they're right 2 years from now or 3 years from now, but we could see it before that happens. They're wrong that it's going to happen immediately right now. That is when that's what I disagree with. Looking at a lot of this stuff, you need to approach your investments with basically thinking that you can't time the market. So you should be buying things that are down no matter what the market is. If you know something's cheap, just buy it. Buy it when it's down and hold on to it. Wait for the market conditions to change where it becomes expensive. So that's where I live. I live on buying cheap assets from all these different sectors. I buy those and then I just wait. I wait for the market conditions to change. Well, they have changed. I'm waiting for the market to realize that the market conditions have changed, and then the monies will eventually flow in. So that's basically all of investing right there. It's not too difficult. Just identify value, make sure the market conditions are ripe, and then just sit in it. That's it. If you guys like this type of analysis, give me a thumbs up. Subscribe to the channel. Subscribe to the website, Platinum membership. I can show you the companies that I'm using to play. I use a whole bunch of different things. I use technical analysis. I use, fractals to identify potential investments, which gives you your risk reward, which gives you that asymmetry. Then I use portfolio position sizing to spread it out. And what I'm trying to do is I'm trying to win huge on some of my bets. I put copious amounts of money in other bets which are just down but have very little risk. That's basically the structure of my portfolio. All right, guys, we'll talk to you later. This is Finding Value.